So this is the normal way. But once you start doing this, you're connecting those 2 points. This is abnormal, meaning this is the actual total opposite. But if you can check between this one and that one, this one and that one is the normal. It makes sense that way because the market is giving you the structure and the stochastic is giving you the structure. Now when the stochastic is giving you this structure, which happens here, you see the total opposite of what is actually happening between the chart and the stochastic. So now, those of you who don't know how to spot divergence, this is how to spot divergence. And the final thing, you check the previous point and you check where you will be at. Because normally when you spot divergence, the market should be here. So you must spot divergence using that. And you will just see with your stochastic and check the previous point. The stochastic was there and the market was there, and you check where you are, which will be this point. If the stochastic will give you the opposite of what is actually happening to the chart so that you can make an entry there. So simple. And from there, what you're going to do is confirm by the crossing over. There are two lines inside the stochastic that move. The red, the purple and the orange line. Immediately after those lines cross here, we're going to be on a buy. And this thing, it ranges, the stochastic ranges from 0 to 100. And the 20 line, it is highlighted. The 80 line, it is also highlighted. So we want divergences where the market touched the overbought and oversold. This is the overbought. This is the oversold. Now, between these 2 points, for a buy, when you are on a buy, we must look for divergence this side. When we're on a sell, we must look for divergence that side in order to take the market down, here to take the market up. So that's how we go about spotting the divergence. Immediately after the crossing here, you enter your buys. And as you enter your buys, the market will go into your direction. Now, coming to the horizontal line that I normally drew, it is for the purpose that in order to after buying here, in order to be able to correctly draw the footprint line, which is this line. Because sometimes you draw a line, you draw a footprint line, and you find that sorry, you find that the market just consolidates around, just plays around. So what is actually happening is that even though you bought there, what we do is that we put the horizontal line. Let me use we put the horizontal line for one reason, in order to wait for the market to break that horizontal line on the above. Immediately after candles close above there, and we find some retests so that we can be able to enter more buys. That's when we conclude that as a footprint. The reason why we do that, it is because of, you see what happened. I didn't, because some will say, here, the market has broken the first layer, so they will even close this sell. So you will tend out to make a lot of mistakes. But if you wait for the market to break this, that's when you can full classify that as a footprint line. After the market breaks the horizontal line that you put there in order to emphasize that thing, it is a footprint, because what we're trying to do, if we're trying to get rid of the confusion that happens, because you find that sometimes you drew your footprint, but it is not where you should have drawn it. The market just gave you fine. After the market gives you and you spot your divergence there, immediately you draw your footprint there and you say that will be a footprint. But you should now know that you must wait. And in order to be perfect, what we do, re-entries now, we'll start to be making them after the breakout of that line, of the horizontal line. So that we avoid the consolidation that normally happens. When we do this, as the market keeps on going down, we know we'll be adding trades. But if you add trades in here and the market doesn't even reach this line and starts to consolidate and go on, forms another point, you put yourself in unnecessary risk that way. And whereas if it comes for the second time and it breaks, that's when we conclude that as a footprint line. So that when you know that if the footprint line gets broken from there, you definitely know that it is a legit footprint. So let me try to illustrate what I'm talking about. Oh yeah, this is perfect, guys. And it's a very smart way to move around it, because you want to enter on a trade. Look, someone will say, okay, I have a full footprint. And someone also use this one as a first layer. Fine. The market breaks, then after that, you see there was a clear divergence, everything. So now in that case, in order to confirm that as a footprint, you'll have to put your line there. And in order for you, after you place a buy here, the market must break and give you a horizontal, a divergence, so that you can keep on adding re-entries. So we can only add re-entries from there going up. Yeah? Now, if you find a situation where when you would have entered here, you will put your stop loss around here, and the distance between where you've entered and the stop loss, let's say it is 50 pips. You will calculate the lot size, and you have, let's say you have $100 account. You calculate the lot size that will say if the market goes against you 50 pips, you will lose the $100. That's the case. Yeah? And now when the market goes into your profit, what you will do is that you will start making re-entries after it has surpassed this level, because of we avoid what? Consolidation. And even here, if you would have made a lot of re-entries while the market is still in here, it would have been problematic because you'll be making it very much earlier. But once we know that, let me show you another example. Okay. So this one, it didn't even, it's a setup that didn't even have a straight first layer. So from here, immediately after the market makes a pullback, we're going to put our line here. So the first trade we'll take it here as the one where after we take it here, we'll put our stop loss here and we'll calculate the lot size that will accommodate us here. Immediately after the breakout here and the retest, that's when we start adding re-entries. The reason why we do that, because we don't want to be in a very risky area. Because normally if you've analyzed the footprint, the way the footprint, even though like when I was starting it, the way I've been seeing the market is the market will do this. Immediately when it loses momentum, it starts consolidating until it breaks. And after it goes into an opposite direction, after it starts consolidating until it breaks. So let me show the visual representation of what I'm talking about. Here is it. It went up. Now it starts to consolidate. Even here. It went up, starts to consolidate. And it happens in different forms or all together. So, but sometimes it really doesn't. But it is the normal case that we normally deal with. So as there is, you guys can see the consolidation there. So as there is consolidation normally here, where we're supposed to spot the footprint, you have to be very careful of how you actually spotting it. Okay. Do this. So this consolidation, I already knew that, okay, here the market is starting to come to a point where we can expect a turn. Because if it had a momentum, it would have continued going. And normally the consolidation is the one that forms the breakout. So I normally know that, okay, this is what is actually happening. And this thing of spotting the thing, it happens also with regards to the time frame size. Yeah. Also accommodate the size. Depending, looking at how big the trend is, like look at how, if you can be able to check and see, okay, you see this big structure, and after that, you use this one, you see this big structure. There's no way you're going to come back and use this one as a thing. Even if you use it, you'll still get an answer of what is actually happening. But what I'm trying to say is that, like the market, I mean, the footprint will be a footprint at the end of the day. So it will show you where will the market be heading. But as we know that this is a consolidation phase at the end of, before the market can even break the first layer, it normally consolidates. So you must be very careful in terms of the structure that you are looking at and how you draw your thing if you're focusing on a certain footprint. But nonetheless, from there you should be worried about something that is already done. And before you can be able to draw your footprint line, you don't have to be in a hurry to do that. You just let the market form that. There's nothing magical that you have to do. You just let the market form that, then you'll be very fine. And yeah, the rest from there, you will just see. So I want us to take a look at something, a trade we can get on for today. Where we can see a very nice setup. I'm on 1 hour. If we can see a full nice setup, we can be able to enter on a trade. So that's one. So still on the downside, so it's not something we can look at unless if we try to decide to go to the, but it is better if we find a situation where a trade where the 1 hour it is showing it is at a divergence. That way we will not have to hesitate to get on the trade.
Brian, can we check GBP JPY?
I'm on it right now.
Oh yeah, thanks.
I wouldn't place on a trade because there's too much consolidation on this trend. So it seems like it will take time for it to go into profit because you can see how it has been coming to and how it is consolidating now. So it will need a lot of patience. So we need to find something that we can be able to place trades today and be able to also eat today.
Hi, Brian.
Yes, what's up?
How are you?
I'm good. How are you, Kenna?
Cool. I just wanted to, I know there's not going to be enough time now, but I just wanted to know, how you actually, because everything that I'm seeing is it's obviously mind-blowing, to all of us, but I just wanted to know your approach, like how you actually, your mentality, your mindset, how you actually came up with the footprint, the first layer, the idea, the approach to it, just your motivation behind it. If maybe you could have a Zoom, maybe dedicated to that, just a bit of time of your just your words, your wise words, if possible.
Yeah, that can definitely happen. So, uh, so it's something I cannot really explain now because it will be like a lifetime story for it, because like I have to explain from what I was looking at, what my mind was looking at in terms of different, because there's definitely no strategy that I don't know in the market. From all the Fibonacci's, from all the stochastics, Bollinger Bands, everything, all the stochastic, all the strategy, support and resistance, all price actions, your galley patterns, basically everything. I know it, and it came to a point where, with all the noise I've been having, I started questioning myself with a lot of things, because I've realized that in the strategy, it doesn't matter how much you know. It doesn't matter. It matters how okay that which you know, if it is working for you, actually, in another way. So if something is working for you, if it is not working for you and it's only confusing you, then it's something that is not really worth having in your mind, that kind of a thing. So I started listening more to myself, because of there's something that felt